How do life insurance companies make money? And what's this on your title page? What is even a life actuary? Well, a life actuary is someone who prices the products and they set the premiums and they also analyze risk on an insurance product or like, such as a term policy or a whole life policy. And I feel like it's really fitting for an actuary to respond to this question. They're the ones that does all the math and the risk analysis behind the scenes. Now, if you were to ask a sales agent for life insurance on what life product to get, they're going to be incentivized to sell you the biggest product that they could possibly get so they can give the most commission. But without many commissions or anything to view, I feel like it's really wise to think about how they get money. And the more you realize it, the more you realize how much you can make a sensible decision for yourself. Now, the way to understand how they make money as a life insurance company, you have to dive into a little bit of a probability lesson. And so, with this, we're going to go into a game show. And this is going to assume that you have these total financial assets. Suppose you have $20,000 in cash, you have a retirement account that's sufficiently funded for your retirement, and you have your house deed. And so you have $150,000 in equity on your home. And so if you were to describe this person, I would personally define them as someone who's pretty financially savvy. So they have a nice emergency fund here. It's not too big of an emergency fund, but it's actually pretty decent. They have their retirement fund. A lot of people are worried that they're underfunded. This person's funded sufficiently, and they have a good equity on their home. And so they have all their assets at the table. And this is their actual assets. And then they're given this game show host, they offer them this following game. And they could play this game as many times as they'd like to. And so they have a 49% chance of winning $100. And they have a 51% chance of losing $100. Would you play? If so, how many times would you play? Would you play until you lost a certain amount, until you gained a certain amount? Well, I hope that you would actually pick and elect to not play this game. And let's dive into a little bit of the math behind it. You can see that you're more likely to lose just by 2% than you are to win. Let's look at it. The math behind the game. So here I have this description up here. In statistics and probability, we call things as an expected value, or in this case, let's say an expected gain. And how you calculate it is you use the probability that you're going to lose, so there's your 51% there, times the amount that you lost, plus the probability that you win times the amount gained. And so I have this written out here. So you're going to lose 51% of the time, you're going to lose $100 plus 49%, that's probability you win, and you win $100. And so if you're to add all of this up, it's negative $2. So what does this mean? Every single time you play, you can expect to lose $2. Well, that doesn't really make sense because initially, because you can't. This is not even one of the options. Losing $2, you either lose $100 or you gain $100. Now, this is the expected gain over many rounds. So, suppose that you were to play 100,000 rounds on average, you'd lose $2 per round. And so, with your $20,000 that you have in your financial assets, you're expected to be bankrupt in $20,000 divided by $2. So, that's 10,000 rounds. And so, I actually wanted to make a little simulation to illustrate this. And so, I have here this gray line. This is the expected amount of money you're going to have left after each round. So, here on the x axis, I have the number of rounds played. And then I have here on the y-axis, I have how much money you have left. So you start out with $20,000 and you're going down every single round, $2. That's the expected amount. And you can see here at round 5,000, that hits right at $10,000. So how I said, you're going to run out and you're expected to be bankrupt in 10,000 rounds. Here, in 5,000 rounds, you're expected to be halfway there to bankruptcy or $10,000. Well, in this simulation I ran, I almost was pretty disappointed and I was going to run it again. But actually, I thought this told a lot of lessons. First off, it says that even though the expected amount of rounds that you play until bankruptcy is 10,000 rounds, it actually can turn out quite different from that. This person in this simulation actually ended up being bankrupt around 5,500 rounds. Another thing that it illustrates is that it does every single course of actuality is pretty different from expected. This one, you could be bankrupt 5,500 rounds or 20,000 rounds or 50,000 rounds perhaps, but eventually you're always going to get bankrupt with this scenario. And that's because you have this expected value of negative $2. You're less likely to win than to lose. Another lesson that this teaches is look, you start at $20,000, but this person actually ended up in round like 1,300. They actually ended up with this positive gain, maybe here at $21,000, $22,000. And then so you'd say, well, Jacob, why would you say to not play? This person ended up with more money at a certain time and they should have just stopped at this 1,200th round. Well, the answer to that is you never know. You never know if you're going to ever get to a positive gain. You could have possibly gone to $19,000 before you got in a gain and just never caught up. And so let me jump into another game show or another scenario, and we're going to this will help us understand insurance a little bit more. And this one I titled a game show nightmare. And so you're assumed your same financial assets. And this time, the game show host forces you to play this game one time or not play at all. And you have to pay a fee of $10,200. Remember, you only have $20,000 cash here. And so this game, you have a 90% chance of losing nothing. Okay, great. Or you have a 10% chance of losing $100,000. Now, this question, would you pay the fee or take your chances? I would suggest that you pay the fee because of this. If you lost $100,000, what would the consequences be? They'd be actually quite awful. If you lost $100,000, now you have to either dip into your retirement fund, you have to pay an exuberant amount of taxes, or you'd have to sell your home or get some crazy loan on your home equity. Look here at this expected gain on this game right here. So I have the probability to lose times the amount lost. This expected gain right here is 10% times this negative $100,000 plus 90% times you lose nothing. It's only negative $10,000, although there's a fee of $10,200 of not playing at all and waiving that. Well, you would initially think, well, if you're going to look at it statistically, you're going to lose more playing once. You're expected to lose more on paying the fee. But that's the thing. Although you're expected to lose more by paying the fee, what it's going to do to you if it did land on the 10%, it would ruin you. You don't get the opportunity in this game to play with the law of large numbers. So the risk is really high for you. It just ruin you financially. And this is how insurance works. The first game show, that actually represents gambling. And so that is where, and the first rule of gambling at casinos, the house always wins. And it actually could be tied to an insurance company being the 51% chance of winning $100. Insurance companies, they get the advantage of playing the law of large numbers. So they get a lot of policyholders, and they set the premiums right, and they'll get this slight advantage of winning. And then so they're expected to win, where the policyholder is expected to lose. But the second game, this represents you. And so this represents real life and the potential benefit of insurance. And so if you were to, let's say you were going to die, or let's say you had a really huge medical issue happen to you, Well, what insurance would do is it'd step in and take out that risk of the financial loss that's going to happen in those circumstances. Now, I have a little scenario here, just for a little thought. If the second game show was switched to either playing this game or paying a fee of $10, what would you do? Have his 10% chance of losing just merely $50 or 90% chance of losing nothing, you probably would want, I would personally avoid not paying the fee. I'd play the game because losing $50, that wouldn't mean much to my $20,000. And you can see here your expected gain here is only -$5, where the fee is much more than the $5. It's $10. It's double that. So I would play the game in this circumstance. But with the $100,000, it's a completely different story. Now, with this in mind, we can look into how insurance companies make money. Us as actuaries, we use this it's a little simplified here, but we use this formula right here. We use this formula that where the premiums paid in, or the expected premiums paid in, plus the interest that we get on the premiums, minus the benefits or the death benefits that we pay out, minus additional expenses. That has to be greater than zero. And if that's greater than zero, then the insurance company has made a profit. So, in other words, the company needs to make more in premiums than they pay out. And their additional expenses, what's that? That's their commissions, that's paying actuaries, that's paying keeping the lights on at the insurance company, etc. And so as long as they get more premiums than what they pay out, they're good. And so they need to make sure that they're expected to win and that the policyholder, in most circumstances, is expected to lose. Note that also there's interest on premiums, and interest on premiums can be substantial. And so the insurance company just doesn't sit on the money and wait to pay people out. They actually invest the money, and they're very savvy with it and very smart with getting the interest on the premiums. And what that does is that makes it so premiums are cheaper for policyholders. So they stay competitive. They're trying to be as cheap as they can, but still be competitive and get profit. And because insurance companies, as I said before, because insurance companies have many policyholders, the law of large numbers is on their side, even though they lose money on many policies. So a policyholder could die, they could purchase a policy and then die the next day. In that case, the insurance company lost. But they get to play this game so many times with so many policyholders, as long as they're expected to win, they're going to get, on average, a gain. And so I just wanted to go and talk about this scenario with you, where if you're expected to lose, the amount of insurance you should buy is just enough to offset any major risks and to make sure that you can live a financial lifestyle that you want to. I recommend that you watch my video on what life insurance product you should buy, and I explain a little bit more about it. I had a insurance agent. He was talking to me about. I was explaining to him I had a deductible. I had about $10,000 deductible on my health insurance, and he said, "Oh, you should get rid of that. Let's get you more insurance so you can remove that deductible." And I thought to myself, I'm willing to accept this risk of $10,000, although for some people that is too substantial. Or maybe you would set your limit at $20,000. I decided to set it at $10,000 for my risk level. And I said, no, I already understood that I'm expected to lose if I pay the premiums to remove a deductible. And so, here, lastly, this last thought. Just because you're expected to lose on buying insurance doesn't mean you shouldn't buy it. So, remember that nightmare game show scenario. And that's why insurance is needed. In fact, I would argue that most people, sometime in their life, need life insurance. It's a need. And I'd also recommend to check out my politics versus insurance companies video. And so that one I actually dive in a little bit more on how politics is against insurance companies and what negative results that has. And so I'd say purchase enough insurance to offset needed financial risk. And then, as I stated before, life insurance is a need for most people sometime in their life, and it's not merely a financial instrument. I hope you enjoyed this video, and I hope you learned much from it.